Hello, traders and aspiring market mavens. Welcome back to Mental Market Mastery. Today, we're diving into a topic that's crucial for anyone looking to thrive in the trading world. We're exploring the invaluable lessons from Mark Douglas's renowned book, Trading in the Zone. This book is a treasure trove for those seeking to understand the psychological landscape of trading. I know many of you, like myself, have struggled with the mental and emotional aspects of trading. It's not just about charts and numbers. It's about how we think, how we react, and how we cope with the roller coaster of trading. Today, we're focusing on one of the most transformative chapters of Douglas's book. Chapter 3: Taking Responsibility. This chapter isn't just about trading. It's about reshaping our entire approach to the markets. We'll delve into the essence of developing a trader's mindset. That state of mind that separates consistently successful traders from those who struggle. We're talking about building discipline, conquering fear, and staying emotionally balanced. And it doesn't stop there. We'll also uncover the secrets of accepting the risk and reward of each trade, why blaming the market gets you nowhere, and how to foster a positive, winning attitude no matter the market conditions. Whether you're a seasoned trader or just starting out, these insights are vital. They're about transforming your trading journey and, quite possibly, your life. So, buckle up, grab your notepad, and let's embark on this journey to master the psychology of trading. And if you find these insights helpful, don't forget to like, subscribe, and share this video with your trading community. Now that we've set the stage, let's dive into the heart of developing a trader's mindset. What does it really mean to have a trader's mindset? It's a term thrown around a lot, but let's unpack it. At its core, a trader's mindset is about two things: discipline and objectivity. Discipline means following your trading plan without deviation. Objectivity involves making decisions based on facts and data, not emotions or hunches. Let's take an example to illustrate this. Imagine two traders, Trader A and Trader B. Trader A has a set of well-defined rules. They've done their homework, they know their entry and exit points, and they stick to their plan. Trader B, on the other hand, is led by intuition. They might feel good about a stock because of a news article or a tip from a friend. Their decisions are based more on a gut feeling than on a structured analysis. Now let's say the market takes an unexpected turn. Trader A looks at their predefined strategy, makes adjustments if necessary, and keeps their emotions in check. They understand that not every trade will be a win, but their discipline keeps them grounded. Trader B, however, is in a different boat. Their trading is reactive. If a trade goes south, they might panic and sell off too quickly. Or, if they have a win, they might become overconfident and make reckless choices. The difference here is clear. Trader A, with a disciplined and objective approach, has a better chance of consistent success. They might not hit the jackpot on every trade, but their methodical approach minimizes losses and capitalizes on gains over time. Think about it. Trading is not just about picking winners. It's about managing risk, being patient, and staying the course even when your emotions are pulling you in different directions. This is what developing a trader's mindset is all about. It's not glamorous or thrilling like the movies make it out to be. It's methodical, disciplined, and above all, consistent. And that's the beauty of it. So, as we move forward, ask yourself, are you more like Trader A or Trader B? And what steps can you take today to start developing a more disciplined, objective approach to your trading? Remember, the journey of 1,000 miles begins with a single step. Moving on from developing a disciplined mindset, let's tackle one of the biggest challenges in trading: fear. Fear can be a trader's worst enemy. It's sneaky, It's powerful, and it can derail even the most well-thought-out trading strategies. Why is fear such a big deal in trading? Well, fear can cause us to make irrational decisions. It can make us exit profitable trades too early, hesitate on solid opportunities, or even abandon our trading plans altogether. But how do we combat this? One effective strategy is having a clear trading plan. A plan acts like a roadmap. It guides your actions and gives you a sense of direction, especially when emotions run high. Let's look at an example. Imagine a trader. Let's call them Sam. Sam had a significant loss a few weeks ago. It was tough, and it shook their confidence. Now, they're hesitant to make any trades, fearing another loss. Sam spots an opportunity that aligns perfectly with their strategy. But that fear, the memory of the recent loss, holds them back. They hesitate, and by the time they decide to go for it, the opportunity has passed. It's a classic case of fear costing more than just peace of mind. It cost a real opportunity. So what could Sam have done differently? Firstly, acknowledging the fear is crucial. It's okay to feel scared. But what's more important is not letting that fear dictate your actions. Sam could have relied more on their trading plan. By sticking to the criteria set in the plan, they could have made an objective decision rather than one clouded by fear. Remember, losses are a part of trading. They're not fun, but they're not the end of the world either. Learning from them, rather than fearing them, can transform your trading journey. Another key strategy is gradual exposure. Start with smaller trades to rebuild confidence. As you see your plan working, your fear will start to diminish. It's about proving to yourself that you can trust your strategy and your decision-making process. To sum it up, the elimination of fear in trading isn't about never feeling scared. It's about not letting that fear control you. It's about sticking to your plan, learning from the past, and gradually regaining your confidence. So take a deep breath, trust your plan, and remember, every trader has been in Sam's shoes at some point. It's not the fear that defines us, but how we respond to it. Having tackled the fear factor, let's pivot to another crucial aspect of trading psychology: emotional restraint. It's all about not letting recent wins or losses sway your trading decisions. Sounds simple, right? Well, it's easier said than done. Trading can be an emotional roller coaster. A big win can make you feel invincible, while a loss can leave you doubting your every move. But here's the thing: overconfidence and underconfidence are both dangerous in the world of trading. Let's bring this to life with a scenario. Meet Alex, a trader who just had a big win. They're feeling on top of the world. So what does Alex do? They decide to size up significantly. The thought process? I just nailed a big trade, so I'm going to nail this next one even bigger. But here's where things go south. The market doesn't care about Alex's recent win. The next trade, unfortunately, doesn't go as planned. And because Alex sized up so much, the loss is not just a small setback. It's an outsized loss. It's a classic case of overconfidence leading to a disproportionate risk. Now, if Alex had exercised emotional restraint, they would have stuck to their usual trading size. They wouldn't have let that one win cloud their judgment. It's crucial to remember that each trade is independent of the last. So, how do we maintain this emotional restraint? First, acknowledge your emotional state. Whether you're riding high from a win or reeling from a loss, take a moment to check in with yourself. Second, stick to your trading plan. Your plan should be your anchor, keeping you steady regardless of the emotional tides. It should dictate your trade sizes, entry and exit points, not your recent trading outcomes. And third, practice self-discipline. This might mean taking a break after a big win or a loss to ensure you're in the right headspace for your next trade. Remember, in trading, consistency is key. Emotional restraint is not about suppressing your emotions. It's about not letting them dictate your trading decisions. Keep this in mind. The market is always there. There's no need to rush back in after a win or a loss. Take your time, stay disciplined, and your trading journey will be all the more rewarding for it. All right, we've covered emotional restraint. Now let's dive into a fundamental aspect of trading that can make or break your success: understanding and accepting the risk-reward of each trade. Every trade comes with its own set of risks and potential rewards. As traders, it's our job to understand these risks and decide whether the potential reward is worth it. This is where risk management comes into play, and it's not just a fancy term, it's the backbone of successful trading. Let's look at an example. Meet Jordan, a diligent trader who never enters a trade without calculating the risk-reward ratio. For Jordan, a trade isn't just about the potential profit, it's about how much they're willing to lose to achieve that profit. Before each trade, Jordan assesses the potential upside and downside. They ask themselves, if I'm aiming for a $1,000 profit, how much am I willing to risk? $300? $500? This calculation helps Jordan decide whether a trade aligns with their risk tolerance. This meticulous approach does two things. First, it instills discipline. Jordan doesn't make trades based on whims. Second, it provides clarity. There's a clear understanding of what's at stake with each trade. Now, why is this important? Because in trading, losses are inevitable. But what matters is how you manage those losses. Good risk management means you can withstand losses without jeopardizing your entire portfolio. If you're new to this, start by defining your risk tolerance. How much are you comfortable losing per trade? This shouldn't just be a random number. Consider your overall capital, your trading goals, and your emotional comfort level. Remember, the goal isn't to avoid losses. It's to manage them in a way that keeps you in the game. It's about making sure that when you win enough to cover your losses and then some. So take a leaf out of Jordan's book. Calculate your risk-reward ratios, stick to your risk management rules, and watch as your trading foundation becomes stronger, trade by trade. We've just explored the importance of risk management. Now, let's address a common pitfall many traders fall into: blaming the market. It's an easy trap to fall into, but it's also incredibly counterproductive. Why is blaming the market a problem? Because it takes the focus away from where it should be, on our own decisions and strategies. The market is a force of nature. It's unpredictable, and it certainly isn't out to get us. Let's consider a scenario. Meet Taylor, a trader who's just experienced a significant loss. Their immediate reaction? The market was manipulated, or it's just bad luck. Taylor is looking outward, not inward. By blaming the market, Taylor misses a critical opportunity for self-reflection and learning. What if the loss was due to a flaw in their strategy, or a misreading of market signals? Without accepting responsibility, Taylor is doomed to repeat the same mistakes. Taking responsibility for our trading decisions isn't just about owning up to losses. It's about empowering ourselves to learn, adapt, and grow as traders. Every loss, every setback, is a chance to refine our strategies and improve our skills. So, what should Taylor do? Start by analyzing the trade. What were the conditions? What signals were present? Was the loss a result of market conditions or a strategic error? This kind of analysis turns a loss into a learning opportunity. Remember, the market isn't your enemy. It's a complex environment where we test our skills and strategies. Blaming the market for our losses is like a sailor blaming the sea for rough waters. It's unproductive, and ultimately, it holds us back. Embrace every aspect of trading: the wins, the losses, the unpredictable nature of the market. Learn from it all. This is what shapes you into a resilient, adaptable, and successful trader. Having discussed the importance of not blaming the market, Let's now turn to a crucial aspect of trading psychology: developing a positive, winning attitude. This isn't about being naively optimistic. It's about maintaining a constructive mindset that helps you navigate the ups and downs of trading. Why is a positive attitude important? Because trading is as much a mental game as it is a strategic one. Your outlook can influence your decisions, your reactions to losses and wins, and ultimately, your trading performance. Let's look at a scenario that illustrates this. Meet Jamie, a trader who keeps a detailed journal. But Jamie's journal isn't just about entry and exit points or profit and loss. It's also about their emotional state and the lessons they learn from each trade. For example, after a losing trade, Jamie writes about how they felt, what they could have done differently, and what they'll do to avoid similar mistakes in the future. It's a way of turning a negative experience into a positive learning opportunity. This journaling practice helps Jamie stay optimistic and focused. It's a reminder that trading is a journey, with each trade providing valuable insights. It's not just about profits, it's about personal growth and development. So, how can you develop this positive, winning attitude? Start by acknowledging both your successes and failures. Celebrate the wins, no matter how small, and learn from the losses without being too hard on yourself. Another technique is to set realistic goals. Not every trade will be a winner, and that's okay. Setting achievable, incremental goals can keep you motivated and grounded. Lastly, surround yourself with positivity. This could be a supportive trading community, educational resources, or even motivational quotes that keep you inspired. Remember, your environment plays a huge role in shaping your mindset. A positive, winning attitude is about resilience, learning, and staying motivated. Embrace the journey with all its challenges and triumphs, and watch as your trading and your outlook on life transform for the better. As we come to the close of our journey today, let's take a moment to reflect on the key principles we've explored from Mark Douglas's insightful book, Trading in the Zone. We started by understanding the importance of developing a trader's mindset, focusing on discipline and objectivity. Remember, trading is not just about analyzing charts. It's about having the mental fortitude to stick to your plan. Then, we delved into the critical issue of fear in trading. We saw how fear can paralyze us and how having a clear trading plan can help mitigate this fear, keeping us focused and rational. We discussed the importance of emotional restraint. It's essential not to be swayed by recent wins or losses, but to remain consistent and objective in our approach. This helps us avoid the pitfalls of overconfidence and underconfidence. We also tackled the necessity of accepting the risk-reward of each trade. Effective risk management isn't just a safety net, it's a cornerstone of successful trading. And finally, we talked about the power of a positive, winning attitude. It's not just about being optimistic. It's about learning from every experience, whether it's a win or a loss, and continuously growing as a trader. I encourage each of you to take these principles to heart. Practice them in your trading. Reflect on them. And most importantly, use them to grow not just as traders, but as individuals. I'd love to hear your thoughts and experiences. How have you implemented these principles in your trading? What challenges have you faced, and how have you overcome them? Let's start a conversation in the comments below. Your insights could be the encouragement someone else needs. Before we wrap up, I have something special for all of you who are keen to dive deeper into the world of trading psychology and learn directly from the master himself, Mark Douglas. If you've been inspired by our discussion today and want to explore Trading in the Zone in its entirety, I've got great news for you. You can access the audiobook for free with an Audible trial. That's right. Just head over to audible.com. If you're a new user, you can sign up for a free trial and choose Trading in the Zone as your first audiobook. It's an incredible opportunity to hear Mark Douglas's insights and strategies in his own words, and it's absolutely free with your trial. I personally love listening to audiobooks on Audible, especially when I'm on the go. It's a fantastic way to make the most of your time, whether you're commuting, exercising, or just relaxing at home. So take this opportunity to deepen your understanding of trading psychology. Click the link in the description below to start your free trial on Audible and get your hands, or rather your ears, on Trading in the Zone today. Trust me, it's a game changer for any trader. Thank you for watching, and as always, happy trading. Don't forget to like, subscribe, and hit that notification bell for more content like this. See you in the next video.